Hey everybody, Matthew Paulson here, and today we are going to finish our two-part series on venture capital. We are going to talk about deal structure, PPM documents, preparing to pitch, and due diligence. Let's do this. This is officially episode 25 of Startup Q&A, the online video show that helps small business owners, startup founders, and entrepreneurs grow their businesses faster and achieve their dreams of financial freedom. So whether you're just getting started or if you have 100 employees, this is the show that will give you actionable ideas and advice that you can implement in your business. Now today we are going to finish a two-part show on raising money for your business. Last week we provided a general overview of what raising money looks like in the venture capital world. Today we are going to discuss deal structure, PPM documents, preparing to pitch, and then due diligence as well. So these two episodes were inspired by some questions from my friend Lisa Groon. So Lisa, I'm going to do my best to answer your questions again today, and hopefully this will be a resource that is helpful to you as you go on a quest to raise money for your business, maybe. So this episode will focus on the pitch, preparing to pitch, making a pitch, after the pitch, what the whole process looks like, and then finalizing the deal and getting the money in your bank account. That's what we're talking about today. So before we dive into the questions and go any further, let's move on to the tip of the week, where I provide you a tip, trick, or idea that will help your business grow your business faster or achieve your dream of financial freedom. So this week's tip, not directly related to venture capital, but still a very good tip, is to write shorter emails to your audience. So if you want your subscribers to actually read your email and do something, send them a one-sentence email in the form of a question, and then give them a single call to action. So when I do this, I did this for a fundraiser I was doing for the March of Dimes. They have an annual March for Babies event. I'm on their board, so I thought I would raise some money. Sent an email to the Market Beat audience, and I just said, hey, are you still interested in helping raise money for the March of Dimes through this fundraiser, ? And the next line said, if you are, click here to make your contribution, and then Matthew Paulson, and then my email signature. That really short email raised probably, I think, between $2,000 and $3,000 for my campaign. From one email. It was probably twice as effective as the email before that. Like I said, about 10 emails in total. We raised about 20 grand, and I think that single email was the one that had the best traction. So when we send out these kind of these really short emails, the digital marketer crowd calls these like 9-word emails, and they don't have to be 9 words, but that's what they call them. I see open rates that are typically about twice as high, click-through rates that are twice as high as my normal email. And the reason these emails work so well is that because since they're so short, people actually take the time to read them. When you see a long email, your eyes just kind of glaze over and you skip on it, and you don't want to do it because it's work. But with an email so short, you can't really help but read it, and they just work really well. So they take less time to write. They tend to get higher open rates, get higher click-through rates. Obviously, not every email can be a 9-word email, but you can certainly use them as part of your campaigns. Have a nice short email, maybe ask for a response. You tend to get really good open rates. So that is the tip of the week. Let's dive into the questions. Every week we take 4 or 5 questions that are submitted through Facebook or through our website, and we try to answer them. So if you would like to have your question answered on a future episode of Startup Q&A, go to the domain startupqa.co, fill out the form to submit your question. These questions are all again asked by my friend Lisa, so we are going to try to answer Lisa's questions today. So the first question is, what are some different ways that you can structure your deal? So not every deal is like Shark Tank, where they say, I'll give you 10% of my business for $100,000. That's considered a straight equity deal. Certainly some deals are done that way, but not all of the deals are done that way. Many early stage deals are also done in the form of convertible debt, which is basically a loan with an interest rate that converts to equity if something happens at some point in the future, like they raise a bigger round of money. So you might hear something like, we're raising $1 million in convertible debt at an 8% interest rate, at a $5 million cap, and a 20% discount. So what all this jargon means is that they want to borrow $1 million, so they want to raise $1 million in capital, and they're willing to pay an 8% interest rate on that money. And if they happen to raise a larger equity round in the future, your debt balance, typically they won't make payments on it, your balance will grow. You will convert at whatever the round valuation is. So say we raise money at $8 million instead of $5 million. Since that $5 million cap was in place, your money converts at $5 million with a 20% discount. which would actually be like, so it'd be $8 million as your round. A 20% discount is $6.4 million, but since you had a $5 million cap, it would convert at a $5 million cap in interest, or it would convert at a $5 million valuation. And then whatever money you had accrued in interest, that would also convert to equity at that $5 million valuation. So the reason companies do convertible debt, the math is kind of complicated, I fully admit that, is because they don't really know what valuation their business is. It's too new, too small, too unknown to put a number on it. So they'll do convertible debt, put a cap on it, and that way the current investors will get whatever the next round is at a slight discount with some interest rate for making the investment earlier. Caps are just a really good way to make sure early investors don't get diluted when raising money through convertible debt. You definitely want to have a cap if you're gonna be an angel investors. I probably wouldn't do a convertible debt deal that doesn't have a cap, because if they raise money at a really high valuation, then that my debt converts at, say I put money into a company, convertible debt, and doesn't have a cap, my money's going to convert at that same valuation that the company a couple years later that is putting money in is investing at. But I put my money in 2 years earlier. I took on a lot more risk than they did, so I want to be rewarded through that, and the way to do that is to put a cap on your valuation. Certainly some deals do happen through straight equity. So you might hear something like, we're looking to raise $1 million at a $5 million pre-money valuation. That means they think their company is worth $5 million right now. And then when you add your $1 million to it, it'll be worth $6 million. So for putting $1 million in a company, you would get 1/6 the company. Obviously that is a much more simple kind of deal. There's also a new type of agreement called a SAFE, which stands for a simple agreement for future equity. These are very streamlined deals designed to simplify the fundraising process, reduce fundraising costs, they pretty much allow an entrepreneur to raise money earlier on, and then that money will convert to equity during the next round of funding. It does operate somewhat similar to convertible debt, but there's typically not an interest rate that gets paid as part of the deal. So if you're looking to do maybe a smaller deal or a simpler deal, maybe look at the SAFE paperwork online. It can definitely save on legal fees to use the SAFE framework over convertible debt or equity and a more traditional thing, because typically like the paperwork's already done for you. You just kind of fill in some blanks. The investor fills in some blanks, then you've got your paperwork. You don't have to pay a big pile of money to a securities attorney to set it all up for you, because it's more of kind of a cookie cutter kind of deal. Next question is, what is a private placement memorandum? So a private placement memorandum, more commonly known as a PPM, is a legal document that's prepared by a securities attorney that outlines your investment opportunity and allows an accredited investor to make their investment and complete kind of all the paperwork. So it's going to have a bunch of legal information about the terms of the investment and what your investors' rights and responsibilities are as shareholders of your company. It will have a lot of legal disclaimers in it. It will have typically a confidentiality agreement. It'll tell you over and over again that you're going to lose your money and that this is a high-risk investment. Typically, you won't discuss a lot of the inner workings of your company, but it will include like a subscription booklet, and that's the paperwork that the investor actually fills out to sign up to buy part of your company. So they'll fill out their subscription booklet, they'll write a check, they'll send that to your securities attorney, it'll sit in escrow, and when your deal is done, then you get the money out minus the securities attorney's fees. So PPMs tend to be very complex documents. They're between 50 and 100 pages long. You shouldn't try to find a template PPM document and do it yourself. That is a great way to get in trouble. I was looking at a deal last year out of Brookings, South Dakota, and it was very obvious they used a template PPM because it had some dates from the PPM that they copied. It had like some 2009 dates, and this was a 2016 deal. So it was pretty clear that they just stole somebody else's PPM, changed the dates, put some of their information in there, and it was not done very well professionally. And that was kind of enough for me to say, okay, these guys aren't working with a securities attorney. This is going to get them into trouble. They don't have their stuff together. I probably shouldn't invest. So don't try to do your own PPM document. Have a professional create it for you. You can get yourself in serious legal and financial trouble if you just try to copy and paste a PPM off the internet. If you're ready to start pitching angel investors, you will need that PPM document in place. Go talk to other people that have raised money in your area. ask them like who they use as their securities attorney to create the PPM document, get a personal recommendation from somebody that you know or you meet, and then go ahead, talk to them, spend the money, get the PPM document in place. I really do think you should have a PPM document in place before you go out and do a bunch of pitches, because if somebody wants to give you money, you want to be able to go and take it from them right away as soon as they verbally agree to the deal. You don't have to wait 60 days for a securities attorney to make the PPM document, get everything in place, because that's a long time and you never know if somebody is going to change their mind. So if you're going to be able to pitch an angel investors, you should be able to bring a PPM document with you, have kind of the terms in place, and be able to bring them an opportunity. Definitely have it ready if at all possible. And that way, one, it looks more professional, like you're seriously doing a deal and you're not just some guy looking for money. Even if you are just some guy or gal looking for money, having that PPM document in place is very important. It shows that you're going through all the right steps and doing all the right things that you're supposed to be doing, and that you're not trying to do any shortcuts or half-ass your way to raising money. Next question is, how do I prepare for a pitch? So you're going to have to do a lot of homework prior to your pitch. You're going to need to identify a valuation and terms for your deal, and have a PPM document in place, and then have a slide deck ready. So your slide deck will be 20 to 30 slides about your business that outlines the history of your company, its business model, its management, its financials, its growth opportunity, risks, and then any past fundraising you've done. Obviously have somebody else review your pitch document or your pitch deck. Look for mistakes and errors so that the investor doesn't notice them, somebody else notices them first. That's always good. Don't try to check your own pitch deck because you're going to be blind to the mistakes that you made. You really want to have a good slide deck, so good pitch in place, for your angel investors, because that would just give them a really good overview of your business and help communicate stuff in a way that maybe you can't verbally. Lots of people, like when they're trying to filter down from 100 investors to maybe 10 to actually pitch, they'll send them a slide deck, and then investors, we don't want to read long documents, but we're certainly like page through a slide deck and scan through it, and then if it's interesting, we can take a closer look. So lots of people use their slide decks as kind of a business card, not a business card of sort, but kind of an opening pitch, an opening document to pitch before the actual pitch. People use their slide decks for that. You also, as you're preparing for a pitch, you want to do some research on the person that you're pitching. View their LinkedIn profile, talk to any mutual connections you might have with them. Review what other types of investments they've made. Remember that your investors are going to be a partner in your business, so you should be doing due diligence on them in advance of pitching them as much as they are going to be doing due diligence on you after you are done pitching them. So think about what questions you might ask them during your pitch, and have them in your head prior to the meeting. The more that you can show people that you're pitching, that you've done your research on them, will just be yet another sign that you've got your stuff together and that you're a professional and you're serious and you're not going to waste their time and you're not going to waste their money. So when it comes time for the actual meeting, show up 10 minutes early, dress professionally, put on a suit or whatever the equivalent is for a lady. Put on, I have no idea. I know nothing about fashion, but if you're a guy, put on a suit. If you're a lady, put on something that's the equivalent of a suit. Just dress professionally, act professionally while you're there. Pretend you're at a funeral or a wedding. Be on your best behavior. Bring paper copies of everything in case the technology doesn't work. And then they have the paper copies to take home with them as well. You really pretend that you're showing up for a job interview, because that's really what it is. Same kind of environment. You really want to show yourself at your best while you're pitching. So let's say you make your pitch. The pitch goes well. You've got the PPM document, you got your slide deck, you got your valuation, you got everything ready. Make your pitch, it goes well. What happens next? So let's say a company, you're the angel investor you're talking to, the angel fund you're talking to is potentially interested in moving forward with you. You'll move into kind of a phase of the investment process called due diligence. Due diligence is just them making sure that what you said in your presentation is true and accurate. And the way that they do this is going to vary a lot from firm to firm to individual. So it's going to be very specific to the people that you're pitching. One investor may do very little due diligence at all, and others may do very intensive due diligence about you, your business, and your industry. It really just depends on what the process is for each group. So if you want to know what somebody's application and due diligence process is, ask them. It tends to be impressive if somebody comes to me and says, "Hey Matt, what is Falls Angel Fund's investment process?" and then is respectful of that process, that comes across a lot better than, "Hey hey, I need money tomorrow, please give me money, and do it by my terms. It's like, I'm the guy with the money, you got to go with my terms and my process. I'm not going to go around my process for you because I've got 100 people knocking on my door asking for money. I'm going to give it to somebody who's willing to follow the process. So ask an angel investor, ask a venture capital group, ask an angel group what their process is to raise money, or for companies that raise money, what is the process of applying, pitching, and due diligence. It will come across as respectful. It's a good thing to do, and it is much better to do that than guess or just assume that they'll go along with whatever you want to do. Many people do try to sidestep the investment process and make the deal really easy for them. Showing that you're willing to play by their rules is just a very good, healthy indicator to an angel investor or an investment group. Let me kind of provide an example of what our process is at Falls Angel Fund to approve an investment deal. So due diligence actually happens when you first apply to pitch our fund. So we have people apply to pitch our fund through an online investment platform called Gust. If they can't do that, we will never consider their application. If they can't do the basics of applying on our website or our online platform to pitch, that means they can't follow directions. We're not going to invest in your company. So that is the first step. Our format only allows us to hear 12 pitches a year because we're 31 people and it's hard to get us all in a room together. So we probably only hear pitches from, say, 1 out of 10 companies that pitch us. So just on Gust, the application process online, not really have to filter down companies that, 1, meet our investment criteria, and 2, just seem to have their stuff together more than everybody else. So when people apply, we really want them to submit a quality pitch deck. We want them to have their financials together. We want them to clearly outlay who their team is, what their strategy is, what their valuation is, what their terms are. So if an application on Gust is incomplete, or if it's clear that just not a lot of effort was put into it, that application is probably never going to turn into an actual pitch. So let's say Falls Angel Fund, you apply on Gust, you have a great pitch, you've got all your stuff together, and we say, okay, we like you, we want you to come and pitch. We'll invite you to our meeting to pitch our fund. You'll probably have about 20 minutes to pitch. We'll ask you some questions, and then after you're done pitching, and then we'll vote on whether or not we want to move forward and due diligence. So, like we have our meetings at 4 p.m., so you'll show up at 4 p.m. You might pitch at like 4:20 to 4:40, and then we might ask you questions for 10 minutes or 20 minutes after that, and we'll tell you to leave the room. We'll talk about it behind your back and say, do we like this or do we not? We'll take a vote on whether we want to do anything about it. And then if we decide we want to move forward with it, we'll go into a process called due diligence. So we'll have a vote to do we want to do diligence on this, yes or no? The answer is yes. You'll get a call from us later that day or an email and say, hey, we want to move forward with due diligence. Please give us all this information that we want. And then we'll really kind of do a thorough analysis of your company. So we'll ask for like financials, for tax returns, or we'll run a credit report on you. We'll talk to people about you, talk to people that we know that you know about you, including people that you don't give us as references. We really want to know everything there is to know about you and your business when we do due diligence, and we do our best to do that. We might come to your office, check out your business. Really, we just want to do whatever we can to do to verify that what you told us in our pitch meeting, it lines up with reality. And we just do that by looking at documents and by meeting with you and meeting with people that know you. So it can be very involved. Obviously, when you're handing out hundreds of thousands of dollars at a time, that money doesn't come lightly. So we want to make sure we're giving it to people that we're truthful and honest, and we're representing reality versus some imagined version of reality that might exist in their head. So I'd say our due diligence process, I don't know if it's pretty standard, but I certainly wouldn't anticipate somebody doing a whole lot of less due diligence than we would. Certainly they're going to look at your financials, they're going to look at your tax return, probably going to look at your credit report, probably going to come to your office, probably going to talk to a bunch of people about you. That's just what the process is. It's a ton of work. It can be very much a grind. You probably have to come to their offices, even if they're in another state, and work on with stuff with them. It's a big process. It's a lot of money, so you just have to be mindful of that and be willing to kind of jump through the hoops that whoever the angel investor is puts out before you to meet their due diligence requirements. And those are the questions. Before we're done today, let's just talk about what happens after due diligence and how to finally close the deal, get your money, and then what happens next. So let's say that you approve the angel investor, They like what they find out in due diligence, and they are ready to give you money. What happens next? They will fill out the subscription booklet in your PPM document that you gave them or you give them during due diligence. And then they will write a check to either your company directly or your securities attorney. They'll return a copy of their signed paperwork along with the check. You'll get the money to run your business, and you'll be able to use that to grow your company. And then hopefully years down the line, or a couple years down the line at least, your company will either get really big and get bought out by an even bigger company, or you'll go public, become a publicly traded company like Apple or Microsoft or Google. Or you can also do an owner buyback provision. So you might have a provision in your documentation that you can buy out your investors at some point in the future at a predetermined multiple. So say your company does $2 million in earnings, you've got a 5x buyback provision. So you could buy back their shares at 5 times earnings. So you could buy their shares back at a $10 million valuations. Like, that's not uncommon, but typically it is a buyout of some kind or an IPO. That is how investors tend to get their money back from these types of deals. Angel investing and taking money, it can be a very fun and rewarding and profitable thing, but it definitely isn't for everybody. Not everybody should raise money for their business. Some people should, some people shouldn't. If you don't have money and you want to become a really big business, you're probably going to have to raise money. That's just part of the deal. My friend Travis runs all the Scooters restaurants in town. He doesn't have the money to build the building, so he takes on a loan from a bank, and that's okay. It's just that's what has to happen for his business to work. If you're going to have a $100 million a year business and you need a ton of equipment and supplies to do that, you're probably going to need money to buy equipment and supplies to make that business happen. That's just part of the nature of building that type of business, and it's okay. That's just how it is. But for me, MarketBeat, it was just me and my computer over there, spending hours and hours and hours of writing code and working with data and building a service that individual investors found valuable. Didn't need to raise money to do that business. Maybe I'll need to raise money for the next business. I have no idea, but I'm not totally opposed to raising money for business. You just need to raise money for the right types of businesses. And certainly on the angel investor side, it's been a lot of fun, very rewarding as well. I've invested 20 to 30 companies. I've had one exit that was Dollar Shave Club, and I got I think 4 times my money back after holding stock for probably less than 2 years. So that was kind of nice. I've also had a few companies that failed and just kind of never took off and disappeared slowly, and eventually the website just stopped working anymore. And it's like, oh yeah, they're probably dead. So that's happened as well for a few times, and that's all right. I mean, it's part of the deal. Then I've got another company. I won't say the name of it, but I invested at a $4 million valuation in 2014. And then right now they're raising money, Series B, at like a $38 million valuation. So I know that one's going pretty well. Their current round is 10 times what I invested at. So theoretically, the $3 to $5 grand I invested is now worth 30 to 50 grand. And hopefully they'll get it bought out by somebody, and I'll get that money back and then some to cover those losses that I had. Actually, the Dollar Shave Club money, that actually covered all the losses to date. So I think I'm probably above zero in terms of the money I've gotten back versus losses. So that's definitely a good thing. Yeah, this is fun money. It's not like retirement money, but it's definitely been a fun process, and I'm hopefully not going to lose all my money on these deals. Definitely enjoy being an angel investor. It's been fun to learn about little businesses and invest in them and help them grow and connect them with resources and people. I could probably do this for a while and not get tired of it. I think I'm done rambling, so that is the show for today. So if you would like to subscribe to next week's episode of Startup Q&A and get next Monday's show delivered to you automatically, go to the domain startupqa.co, and there are links to subscribe via email, Facebook, RSS, iTunes, YouTube, and Stitcher. You can also follow me on Facebook at facebook.com/MatthewPaulson page. You can add me as a friend on Facebook at facebook.com/MatthewPaulson. On Twitter, I'm at MatthewDP, D as in dog, P as in pony. And if you enjoy the show, please take a couple minutes, go into iTunes, find the podcast by searching for it. Click the 5-star rating to give us a 5-star rating, and write a review as well. That will help us spread the message of financial freedom through the power of entrepreneurship further and faster. And that will just help us build this audience and help more people hear the message of achieving financial freedom through the power of entrepreneurship. I think that's it. We'll see you all next week for episode 26.